everyone. This is Vishal from EQUITY.GURU, and welcome to Chart Attack. Let's talk about the equity markets. A lot of things have occurred since we got the breakouts on the equity markets. Just a bit of a reminder for those of you who maybe haven't watched previous Chart Attack videos, but we've been saying that the equity markets have been showing a very, very nice bottoming or basing pattern, and a new uptrend is beginning on the S&P 500 on Thursday, November 10th. We just had this epic candle, right? This epic Green Day candle. I believe it was maybe one of the best days of the year, if I'm correct. So we had big pops on all the equity markets. Of course, it was due to that CPI number, the CPI or inflation data for the month of October, coming in lower than expected, which just raised the hopes that inflation is peaking, and that will lead to central banks, specifically the Federal Reserve, either lowering the pace of interest rate hikes, or some even saying pausing interest rate hikes. But again, the Fed has been clear, saying, hey, look, 1 month of inflation data isn't really going to cut it for us. We want to see consecutive months of data indicating that inflation is dropping down lower. And over the weekend, ever since we got this breakout last week, we had Fed Chair Waller come out, say basically the same thing. But then we had Fed Brainerd come out saying, hey, yeah, the Fed is looking to maybe pause sometime soon. And today, now we have Fed Dolly saying that, hey, there's going to be at least another percentage point hike, maybe up to 5%. We're not pausing. It's off the table right now. It's not even part of the discussion. And I think this is just confusing the heck out of markets, right? Different Fed chair members are saying different things about where interest rates are going. And a lot of this market movement has been, basically moving on this whole idea that rates are going to maybe be flattening, or I don't want to say they're going to be cut, right? There's a lot of people saying with the whole Fed pivot is like the Fed maybe cutting interest rates because of a recession, but I don't think that's the case just yet. I think a Fed pivot in this particular instant is more about a lowering, sorry, not a lowering, but a smaller rise in interest rate hikes, rather than your big 75 basis point cuts, maybe a bit lower than that. And the Fed has made it clear, rates will have to stay higher for a very long time, more than a year, perhaps even through a recession, in order to get that inflation number down. They also have to bring in the fact that maybe this whole geopolitical factors, where maybe we were about to start World War III. Maybe that was also weighing in on the markets, and I think it has, because as all of you guys know, we look at two charts to sort of predict where markets are going. One is, of course, that US dollar chart, which also did break down, which is a very, very good sign, right? That there's going to be some some strength in equity markets with the dollar reacting this way, because they are expecting a less hawkish Fed. And now we're just in the basically downtrend, where as long as we're below this 110 level, some sort of lower high to take us lower is in the cards, which again would be positive for equity markets, and heck, even gold, right, which is in the same sort of setup, but the inverse. The 10-year yield, that's the chart that I've talked about a lot, and we've been following a lot. And this is just typical price action, right? A very, very good breakdown, pullback, retest, and a continuation, which is what we wanted to see, right? With the bond market with yield heading lower, it was a good indication that the market sees this as the Fed sort of, topping or calling the top, near-term top of interest rate hikes. However, in this case, I think we also have to remember that when things are going crazy, when there's fear in the world, money tends to run into risk-off assets, which tends to be U.S. Treasuries, right? U.S. bonds, which means that when you buy a physical bond, right? So when you see TLT is going up, as it is right now with this double top pattern, the yields will drop. So in this case, with yields dropping, bonds rising higher, but markets not moving higher, it's more indicating that this is a risk-off movement. Yes, we can also take a look at, say, the VIX as well to back that up. But there's a lot of things going on with the markets right now. A lot of indecision. Is it geopolitics? Is it the Fed? And now the market's sort of questioning whether the Fed's going to be even less hawkish come December. Too many things, to sort of wrap your head around. But technically, from a chart perspective, we are still in breakout mode, and we are still expecting a move higher as long as our support zones are held. So for the NASDAQ, which I think is sort of the best looking chart with a nice downtrend, we have our double bottom pattern. We got that breakout. We're still technically in retest mode where we could see the NASDAQ perhaps even fall a bit more deeper into that 11,500 zone before continuing higher. So even though I don't like the fact that after a breakout, we've had like 3 days of no momentum higher, right? No momentum push higher, which is a bit of a worrying sign because technically when you see a breakout, you'd rather see that momentum continuation happen sooner rather than later. Usually when you have multiple days of just range after the breakout, it's sort of indicating that there's not much momentum or not much buying power left. And perhaps we are in store for a false breakout. But again, that's only confirmed if we close back below this 11,500 zone. And the same applies, for the S&P 500 with this very, very strong breakout. Some people here seeing a cup and handle pattern, but just no momentum follow through. And we've just been ranging. You can see here, this is today's daily candle, so it's still in play, but we've just been ranging between a very, well, I say very small level, but we've just been ranging here between a few points from 39,60 up to 39.90. So just this, I guess a dull range, but that's what we're seeing. And I think the day traders aren't really having too much of a good time unless they're just playing that range. But yeah, this is again not necessarily what you want to see when you have a breakout. You really want to see that momentum sort of continue higher. So I would just advise people to be a bit cautious here. Yes, the breakouts are confirmed. The technicals are still intact. We are still above our breakout zones. However, that momentum is just not there. And maybe we are due for a bit of a deeper pullback in some of these markets, and hopefully not below the breakout zones, because again, folks, if that does happen, then the breakout is nullified and we are continuing lower, and we'll have to wait for a setup to present itself for us to go long, maybe later down the road. But October to December is usually a good month for the equity markets. We tend to get our Santa Claus rally in December. So there's still a bit of hope there, and let's hope things sort of calm down with the geopolitics, and maybe the Fed gets a bit more clear with their message as we get closer to that December meeting. That's it for me, folks. Give this video a thumbs up. Be sure to follow us, and let me know in the comments below where you guys think these markets are going, and if you are sort of worried about this hamper in momentum after major breakouts. I really want to see what you guys have to say, and I'll catch you guys all in the next chart attack video.